As we continue talking about deductions, what is the number one expense that most real estate agents have? Yes, it is the automobile, your largest single expense in general on your tax return. Everybody drives their car, right? To and from meetings, to go show houses, going to closings, whatever the case may be, you're driving your car and you want to be able to deduct your car. However, the IRS has some very specific rules about being able to do that. And the single most important rule is that you must have a mileage log. You must be able to document the miles that you went. The IRS wants to know where you went, why, how many miles it was, what the date was. So here's a pretty picture of a mileage log. Unfortunately, this would not do very well as far as the IRS is concerned, because it doesn't tell me why I went someplace and where I went. There are a lot of apps that are available for you on the internet. Deductor, MileIQ, Expensify, the list goes on. I tried an app a few years ago. Honestly, it just didn't work for me. I've got multiple businesses. About 90% of my travel is deductible for one reason or another. I just found it easiest for myself personally. I just keep a little notebook in the car. And I use this notebook every time I get in the car. I'll take my pencil, grab my pencil. I'll write in here just a few words, the date, the mileage, where I'm going, and the nature of which business it refers to. And that's really all I need. From one point to the next, I record every time I get in the car. And I even record those personal miles, which are not deductible, but I got to keep a track of them. Then occasionally, once or twice a year while I'm watching NCIS, I'll sit down with my laptop and I will transcribe the contents of my log into the computer, let the computer do all the arithmetic. All right, so what is the issue about the log? You've got to have one. There is no ifs, ands, or buts. You have got to have one. Now, I have been in a seminar where a renowned tax professionals team said that, well, all I need to do really is just keep an average for about 3 months and then multiply that by 4 and that would be adequate. No, absolutely not. Why? In January and February, are you doing the same travel that you do in October and November? You've got different clients, you're going different places, doing different things. No, it just doesn't work. So that doesn't work. You can't just say, oh, let me think. 70% of my mileage was deductible, so I'll just deduct 70%. No, it doesn't work. You can't use averaging. You can't use percentage. You have to have a mileage log. Let me repeat this. You must have a mileage log. Okay. Now, let's suppose you don't have a log. If you were a newspaper delivery person, where you've got the same route every day, day after day, day after day, yes, you could recreate. But that's not the case for you as a real estate agent, is it? You're going different places all the time. So you can't just deduct a standard amount. You can't deduct an average amount. You've got to have a mileage log. So the IRS says that there are 2 different ways that we can deduct the mileage. They call this the standard mileage rate method or the actual cost method. Now, the standard mileage rate method is really easy. It's take the miles that you drove for business, multiply it by the standard mileage rate, which for 2021 is going down to 56 cents per mile. And that's what you get for deduction. So let's say that, here's an example. Rick drove 25,000 miles in 2019. Rick's log indicates 20,000 of those miles are business miles. Calculate Rick's mileage deduction based on the 2019 standard mileage rate. Well, in 2019, the standard mileage rate was 58 cents a mile. 2020, it went down to 57.5. 2021, it's going down to 56. So using this, it's really simple. We will take the business miles, 20,000, multiply it by the mileage rate, which is 58 cents a mile for 2019, and the deduction becomes $11,600. Here's the arithmetic for you. That's easy. But guess what? You need a mileage log to know how many business miles you put on. The second way that we can deduct miles on the automobile is called the actual expense method. Now, what kind of expenses do you have on your vehicle? You have got gas, oil, replace the tires, maintenance, repairs, insurance, car washes. You didn't like your stereo, you replaced the stereo. All of these are expenses on your automobile. And guess what? You get to deduct them. Well, actually, you get to deduct a portion of them. And how do we know what portion you get to get? That's by having a mileage log. So let's suppose that these were your expenses. You have about $5,760 worth of expenses. If we were to use the same example as before with 20,000 miles, out of 25,000, that's 80%. So I would take, in this case, I would take 80% of the 5,760 because that's my business use ratio. My deduction then becomes $4,608. You understand this? So in one case, I've got $11,600. In this case, I've got $4,608. Which sounds better? Right. However, with the actual cost method, there's a couple of things that I get to add. I get to add my car registration. I get to add depreciation. And depreciation can be significant. We'll talk about that later. We talk about depreciation. But it can be as much as 50% of the cost of a new vehicle, depending on what the vehicle is. It could be about a maximum for 2020 was about $18,000 for most vehicles. So if we add that on top of this, that makes a significant difference, doesn't it? But we also get to add insurance. We prorate the insurance. See, here are expenses, but that's not really all that we get to deduct. Depreciation is a paper figure. It's not an actual out-of-pocket number. So in comparing the two methods, standard rates and the actual expenses, got to be really careful as to which one you're talking about and keeping track of all the expenses. But guess what? It doesn't matter which one you use. You have to have a mileage log. I think I've made myself clear. You must have a mileage log in order to deduct either one of these. You can't just pretend what it is. You've got to have a mileage log because when the IRS comes knocking at your door, they're going to say, well, what's your proof? For example, I've got a story here about a guy named Duncan Bass, had a landscaping business in Florida, as it happens. And in 2013, he tried to make some deductions totaling almost $30,000 of expenses for car and truck and for other expenses. Well, it turned out he didn't have any records. So what was he supposed to do? Well, he made up these numbers, at least that's what it looks like, and took them to court, took them to the tax court. Tax court turned them down. Here's what it said. It said you've got to have some substantiating evidence. What do they expect? You've got to have adequate records of sufficient evidence corroborating the taxpayer's own statement with the amount of the expense, time and place, the purpose of the expense, and for things like a vehicle, the amount of business use and the total use of the property. So in our case here with Rick, it was 25,000 miles total, 20,000 business use. Substantiation by adequate records requires a taxpayer to maintain an account book, diary, log, statement of expense, trip sheets, or similar records prepared contemporaneously, which means at the same time, with the expense. Documentary evidence such as receipts or paid bills, which together prove each element of an expenditure. In other words, how many miles did you go? What's your proof? Now, some things that you can have, maintenance records. One thing you need to know is what was your mileage on January 1? What's your mileage on December 31? There's your total mileage for the year. And what's a good way to document that? Do you take your vehicle to a repair shop and get the oil changed? If you do, they'll always write down the current mileage. Use that as a method of documenting your mileage. I always write down the mileage every time I get gas. I just write it on the receipt. It just helps keep track of what's going on. Well, Duncan Bass didn't do this at all. He had no records. Ultimately, what ended up happening was the court concluded that Duncan is not entitled to his deductions for car and truck expenses. He lost $10,000 there, and he lost some other deductions that he had for $12,597. In other words, it cost him a lot not to have any records. Now, there are some things that you can add on top of this. You can add any parking, tolls and parking to either one of these methods, whether it's the actual expense or the standard mileage rate. You can add the tolls and parking to either one of those. If you happen to have a leased car, methods are a little bit different. You need to talk to your tax professional about that. And can you change from a standard method to the standard mileage method to the actual cost method? No. From the time you start with one vehicle, you're going to stick with that method until you get rid of the vehicle. If you have multiple vehicles, they don't both have to use the same method, but you're going to stick with the same method as long as you have one vehicle. Any questions about automobile expenses and how to deduct them? It gets a little complicated. Be sure to check with your tax professional.